Conservation, environmental pollution and degradation, environmental impact assessment. 3. What is a Tobin tax? Do you think levying a Tobin tax for climate change loss and damage fund to raise money for development and climate finance a good way forward? Critically examine. 250 words. Difficulty level. Tough. In raising money for climate finance. Introduction. In 1972, Nobel laureate James Tobin had suggested what came to be known as the Tobin tax. In essence, it would be an obligation on financial institutions to pay a cess on their currency transactions, but not investment flows. The ultimate aim would be to raise money for development and climate finance and make a sustainable economic recovery more feasible. Body. About Tobin tax. The currency transactions tax does not impact long-term investments. It is only imposed on the excessive flow of money that moves regularly between financial markets through the actions of speculators in search of high short-term interest rates. The tax is paid by banks and financial institutions that profit from market volatility by taking excessive short-term speculative positions in the currency markets. Tobin tax for climate change loss and damage. The daily global currency trade is worth $6 trillion in this context. A Tobin tax that would be levied on spot currency transactions appears very desirable. Even at a nominal rate of 25%, the tax could annually raise $4.5 trillion globally. This significant amount can fund Sustainable Development Goals, SDGs, and easily enable climate adaptation and mitigation for developing countries. Such capital will also be more resilient, given that recessionary conditions do not gravely affect foreign exchange markets, at least in comparison with global stock and bond markets. Introducing a Tobin tax will not only help in raising resources, but also help financial regulators track global currency flows. This is analogous to the desire for greater transparency and equity that led to sweeping reforms in the global tax architecture through the G20-led global minimum corporate tax. It also tells us that the G20 would be the best forum to drive momentum on this issue. Way forward. In this regard, India can galvanize much-needed support for a global Tobin tax by making it a part of its G20 agenda. A consensus at the G20 will in turn lead to greater acceptance by the international community at large, and remove problems that could arise from a unilateral or limited imposition of this tax. Specifically, India, with a daily foreign exchange turnover of almost $33 billion, should provide the primary impetus to this proposition. Further, given India's interest in finding international coherence around the regulation of crypto assets, a global Tobin tax applicable to such digital assets could be a great starting point. Conclusion. Renewed expressions of support for this tax are required from governments, non-governmental organizations and also civil society. A modern and resilient international financial architecture that is responsive to the needs of the hour can ensure environmentally sound and equitable development for future generations.